My job here is to work on something called what could geospatial data and capabilities do for the theory and practice of finance. And you notice I read that because it's kind of not second nature to me to be using all those terms in all those places. Just a background point, my name's Roger Urwin. I'm the global head of investment content on the investment delivery side of Willis Towers Watson. So that is asset owners across the world, pension funds, sovereign wealth funds, doing sustainability more and more. It's a huge sort of development in our craft, how sustainability works in that respect. And really, when we talk about the theory and practice of finance working more effectively, it absolutely depends on filling a gap, as I see it, which is the depth and the breadth of our perspectives. Finance has been narrow, this is broad, this is multidisciplines. And the one thing I wanted to sort of raise here is that our future really does depend on the ability to kind of get out there more and be a master of the system more. And the best people do that by a combination. They are I-shaped in terms of specialization, but they are T-shaped absolutely in terms of the horizontal line. So T-shaped personness is a key characteristic we're looking for here. So T-shaped people obviously connect dots well, connect well with other people, and they are critical to our ability to thrive in this hyper-complicated world. My best example of a T-shaped person is Mark Carney. But we're struggling with that simply because we're hyper-specialized. And from that point of view, I think we do have too many silos, and therefore I advocate for the 10% T-shaped learning rule, which is basically the key to your job is going to be spending at least 10% of time kind of off the piste, as it were, in terms of learning. I put this into my 10% bucket today. Well done. I think that's the key here. The other point of framing I wanted to do before we kick off this great panel here is to say that the investment model, asset owners, asset managers, etc., really has to face up to a new paradigm of how to do finance well. And I'll start by saying mitigate risk, of course, reduce exposures to stranded assets, certainly long-term environmental risks, capture disruptive opportunities. So obviously that is about companies that have environmentally friendly technologies and solutions one way or another. Last but not least, integrate return, risk, and impact. So the last bit is kind of new. And how you do that is a combination of investing and stewardship. And how you do that a bit more is drawing on the data lake. So extending the sources of data, that's both hard and soft. It's certainly getting a better understanding of the system that we are dealing with here. Just a reminder that we've grown up in a world where it's been a data tap, which has been dripping on the terms of the corporations. Now it's a democratized data lake. And what a massive transformation that is. And obviously what Will has just described is really the sources of that data lake. So much potential. And spatial data is so big in that respect. So there, I've tried to frame a couple of things that are going to be important. Gordon Clark first, just to introduce him, one of the top finance academics in the world, interestingly, a geographer and a finance person. Good combination. My partner in research on governance as well. So Gordon's going to kick off. Mark is head of infrastructure equity at Allianz Global Investors, a practitioner, dealing with real assets, dealing with a focus in the infrastructure area, dealing with impacts, because people are investing with that third dimension in mind. And Will Goodhart, one of the most professional investment professionals I know. CFA stands for the nobler features, in my view, of investing. So a bit more perspective there. He's going to introduce the word ethics, which is great to the whole mix. So the plan is some framing thoughts, then the moderated discussion, and then your engagement. Thank you. So, Gordon, just a few thoughts to kick off.
Okay, thank you, Roger. We've decided, the three of us, we'll sit down and we'll just make some comments more or less structured as we go through this panel discussion. Thank you very much for the opportunity to be here. Thanks particularly to Ben and to Rowan for making this possible. It's wonderful to be here, basically talking about issues close to my heart. I want to make 3 points. I want to talk about predictive models. I want to talk about why major corporations are very interested in these developments. And finally, I want to talk about basically the willingness capacity of the finance industry to get going in this space. A little bit of background. I'm involved in 2 startups in Silicon Valley, which are all in one way or another about data processing in fast time, if you like. Here with Alex Money, who's here in the audience today, a team at Oxford, we've been developing a startup in the area of satellite image processing. And just to reinforce some of the points made by Will, with a beautiful presentation, I must say, that actually the idea that you could have got ahead of the mine collapses in Brazil is possible. It's certainly the case as Alex and I began the company through Catapult, that seeing images of dams, seeing images time and time again of that dam, of the watercourses leading to the dam, the watercourses after the dam, terribly instructive about what you can do and what you can see in the world. Now, of course, you have to know to ask the question. I think that's Will's point. You have to know that we ought to actually go and ask for the images, and we have to have some sense of the dangers or risks associated with dams. And who would have thought, notwithstanding the consulting companies that validated the dam management systems, that they were in fact so vulnerable in the Brazilian case at least. The issue here is actually data image processing that is predictive. And this, I think, is the essence in all finance, being able to build predictive models going on one image after another image, faster and faster in time, better resolution down to the ground, time and time again, is the essence of drawing value out of these types of data systems. Now, as I said, you have to ask the question, is it important to know this? Is it important to know actually what's the status of these dams management systems? And so Alex and I have pitched actually the processing of these images and the issue around mining to major global financial institutions as part of their tools to assess risk of, say, for example, the mining industry whole, but specific companies within the mining industry. Not all companies in the mining industry are born equal, and not all, you might say, have the highest quality of management systems or indeed their own management systems. And that sort of sense in which actually you need, when you talk about making this data attractive to the finance industry, it's got to address a salient risk. That risk has to be recognized by the investment group, and that has to be integrated into their investment decision-making on a predictive basis. It's not much good seeing an image of a dam collapsed after the fact, except for the insurance company who says, by gee, next time we're going to really up the premium that they pay. So predictive models are really important. Depends on the resolution of the data. It depends on the frequency. And then it does depend, I think, very specific to some industries more than others. The second point that I wanted to make, we've been heavily involved in 2 major global corporations, one PepsiCo and the other Diageo. And one of the lessons you learn as you spend time with these major corporations is their actually shortfall in data themselves. And notice I'm not going to talk specifically about any particular company here, but it has struck me that one of the fundamental issues of managing the environment in a major corporation is to know what's going on down the ground. And some companies, more than others, have sought to basically have an integrated data file from the corporate CEO all the way down to the bottom of that last supplier in that most distant country, in that most isolated region. Because there's a realization in major corporations that have that global footprint, that their reputations, in fact, are only as good as actually controlling that last supplier in that far-off country out of sight. And what they've started to do is build up these huge inventories of data, huge inventories of basically their third-party knowledge of what's going on down the ground, because precisely as I said about the mining industry example, really crucial in terms of risk management, there is equally a concern in major corporations to know themselves using third-party data that has integrity, reliability, and has a predictive quality. The last point I'd make about all this is my experience both with asset owners and asset managers is that this issue about grasping the data, using the data on a predictive basis, applying it to industries, applying it to companies specifically, depends a great deal on the capacity of the finance companies themselves to either process the data or apply the data in their own investment activities. And here's the big issue, really. I think basically making it plain, this type of investment strategy using this kind of new kinds of data is salient and important. Important to the finance industry in whole, but important to specific companies who are running active investment strategies, say around mining or say around sustainability. Really important. But of course, not all investment companies have that kind of capacity. Part of it's an intellectual capacity, understanding the risks, having that kind of scope that Roger talked about in terms of investment discipline, but equally having the revenue, that revenue to invest in this type of investment discipline and activity. And I sort of vaguely hope in the grandest possible way that groups like BlackRock and Fidelity will lead the charge. You know, if I was Will, I'd be going to Boston to Fidelity, knocking on the door and saying, oh, we noticed Gordon said you're cash rich. Isn't it time that you invested in what I can do on a predictive basis, on a global basis? Likewise, BlackRock, which has as trumpeted ESG as one of their defining points, isn't it time that they made good on the promise of an ESG strategy through a data-rich investment strategy that takes these kinds of things seriously? And when you go all the way down to the bottom of the food chain in the finance industry, if the big guys don't do it, the small guys can't afford to do it. So I think actually it's incumbent upon leaders in the finance industry to really display and demonstrate actually that they're putting big resources behind the ESG sort of footprint. Last point I'd make, it looks expensive. All this data is expensive to process. All this data is expensive to basically collect and make systematic. What we have to do in 5 years' time is to go to a Bloomberg terminal, if there is such a thing, and be able to just plug in, right? And if that happens, then Will's sort of world will have actually come into direct investment practice. So thank you very much for the chance to talk about these 3 points: predictive, information richness, and actually applying it in the investment management industry.
Generous with applause. So great start. I want to amplify and go into a few of those points, but we're going to deal with each session in turn first. So Martin, investment practitioner.
Yeah, so also really must say it was really great starting, so it's always hard to speak after such a great start. But for as a bit of introduction, Martin Ewald, my name, we're at Allianz Global Investors, so we're the asset management arm of Allianz Group, so this large-scale finance institutions. My specific case, I'm doing real asset finance just in the area of renewable energy and impact. So therefore, also we made use in the past of satellite imaging when we did carbon inventories of RED projects, for example, reducing emissions from deforestation, avoided degradation, where we also saw the limits of non-intrusiveness because we went to Borneo, for example, to do carbon inventory, and as like 60 to 80% is stored below surface. Satellite imaging didn't really help the full road, but at least like carbon inventory as a function of the canopy size is something which is doable. Essentially, our angle towards also climate finance is really ultimately finding a way on how to channel more capital into such areas. In Europe, we're quite active because we mainly work on behalf of institutional investors, which is going along with the renewable energies rather easy. But long run, of course, if we really want to reach like those large volume climate finance numbers we've heard earlier, it is quite obvious that in order to really channel that regulated capital, which does have also limits in where it can go and how much it can take in terms of risks, there needs to be like a richer set of data. From our point of view, really, this is where satellite imaging can help, where it does help, and where it just constitutes the foundation for really coming up with. And in my case, I talk about real asset finance, I talk about unlisted finance, where it can go to those stretches in order to really finance also, let's say, agricultural businesses or also renewables in developing countries, because in the absence of such data, you just don't really know on what to balance your case on. So my daily practice really is ramp up structures, ramp up strategies in that field, and we certainly rely on the data, so therefore I can just concur with all the points you've been making. And really, like if you see those images, really this is like daily practice. We've seen it on the ground, for example, if you search for the right spot to plant, like a solar field or a wind park, let's say in remote areas like in Africa, you need digital imaging because you can't just drive there and have a look into it. It takes you like days just in order to travel to a certain spot. So the more reliable data you have, the easier it is for you to pick spots. And that then ultimately reduces also the time until really money can be put to work. So therefore also there is already right now, it's like really day-to-day use of such data, and I hope that to be intensifying.
So Will.
Yeah, so I'm the chief executive at a professional body called CFA UK. So we're the member society here in the UK for CFA Institute, which is the body that awards the CFA program. Each year now there are more than 300,000 people worldwide who sit one or more of the CFA program exams. And a CFA program exam is intended to develop people as investment professionals. And it's quite a difficult exam. About 25% of the people who start that exam complete it. And in addition, when people finish the exam, we then award them the charter, so long as they have sufficient experience, and we require them to act in accordance with a code of ethics and standards of professional conduct. So this area is really interesting to us, as is actually the whole area of data science, because it affects both the way that we will probably need to teach people about becoming and acting as investment professionals, but also I think has some implications for ethical behavior that have not yet necessarily been thought through completely. So I'm going to probably talk first a bit about where we see people using some of this data at the moment, some of the difficulties with that, how we think that can be used and where the real opportunities are. And then I'll touch, as I say, just briefly on some ethical ideas towards the end of my comments, which will be brief because we've had some very good introductory comments already. When I said that Ben had invited me to participate, well, actually, when I got the invitation, I thought, oh my God, this is an area I know really rather little about, but how exciting. We're interested in data science, and this is clearly a component of data science, and I should take this opportunity to learn a great deal more about it. So I asked my board for feedback. We've got a 14-person board, and one of them came back to me and said, I don't know very much about this, but they were able to give me some information. So my sense is, from that immediate snapshot, that this is an area that the investment sector has not necessarily yet engaged with fully. There are, I think, some pieces of the sector where that has been done better. There are certainly some organizations that have a more developed strategy towards the integration of data science, where they are teaching data scientists to work with investment professionals and teaching investment professionals to incorporate data science. But in this area around Earth observation, some of the sorts of things that people have been talking about are, I think, a little bit more to do with trading, perhaps, rather than investment. So Will talked a little bit earlier about climate and agriculture and oil. Those commodities are obviously an area that is interesting, but we don't believe that those are investments. We think they are things that are traded. You are not really contributing to the terminal value of that asset. You know, you can't engage with a barrel of oil and tell it to be oil better, but you can do that with a retail company. And we think that good investing involves stewardship and engagement. I was very interested in Gordon's comments actually about the use of this sort of information by management. And I think that is a component of an understanding of what is good governance within an organization should become, to what extent is that management, the executive leadership team within that organization bringing into their MI good, complete data, incorporating Earth observation. That, I think, makes a great deal of sense to us. I think there are areas of investment, and some of them have been touched on, where Earth observation can and should immediately be playing more of a role, perhaps, than it already is. One of the things that Will showed us was pictures of ports. I think there are probably quite interesting things that macroeconomists could do to assess levels of activity across an economy or across a sector within an economy, and that would be interesting for investors who are taking thematic approaches. The other area that is very obviously this relatively new technology in terms of having both the data but the analytics behind it to use that is around sustainability. And we again had some very interesting examples of the sort of information that can flow to people. That, I think, is again useful at a macro level or at a sort of sector level, but it's quite difficult at a stock level. And this is something that I was discussing with people yesterday at a different event. The good news is everyone is very interested in sustainability. The bad news is we have a great many conferences on this. It'd be quite nice to be able to get on with it rather than necessarily just talking about it sometimes. But the issue with some of those images is who owns the land? To what extent is somebody directly responsible? Who is responsible for the deforestation? How can you connect the individual stock price or the future stock price or the future stock value to the activity that you can observe? And that actually is quite difficult to do at the moment. But I suspect is something that we'll get better at with better geotagging. It sort of brings me on to the points around ethics. A lot of this is very exciting. And a lot of being a successful investment professional is about gathering assets. And I can see how people could use this data to enhance the apparent attraction of participating in their fund without actually using it to effectively change the allocation of the capital really very much at all. So it would be quite easy to blind clients or advisors or platforms or institutions with your enthusiasm for this new technology and say this distinguishes us significantly from from BlackRock or whoever else it might be, without actually really doing anything at all. And that's a concern. We have, our code of ethics says that you should not misrepresent. Well, I am concerned about, do we have yet sort of a sufficient breadth of knowledge and understanding within the client base to say, okay, let me test that. Let me really check that you're doing what you say you are actually doing. And so I think there are concerns about that. And we require people to be able to make their own diligent, reasonable conclusion about an investment position. If you don't know how this data has been generated, or more likely, you're unaware of how the analysis of that data has actually been done, it's very difficult for you to put your hand on your heart and say, yes, I have done I have been diligent in analyzing this and thinking it through, and I'm confident in my position that I'm taking as a consequence of that. So I think those are specific ethical issues around investment. Just listening to some of the comments, I think there are also concerns about. We talked about if you could predict the potential vulnerability of infrastructure that was going to have human cost. What is the ethical position for an analyst looking at a set of data and becoming conscious that the vulnerability of a particular dam that's built above a village has increased significantly because of rainfall in a region? And what responsibility do they have, or should they have, to actually do something about it in human terms, rather than just worrying about its potentially financial cost, or worse, just deciding to short the stock because of the risk that the stock price might come down because 300 people are going to die next week. So I think there are challenges for us as a sector and a profession that we haven't really thought through. Some of them, as I say, are quite specific to sort of particular activities and processes that investment professionals undertake, and some of them are not specific to that, but are really, I suppose, affect us as human beings.
Great, thank you very much, Will. So on to the sort of conversation part of it, and all our panelists really did talk quite a lot about application, which is where I wanted to focus first. And let me sort of divide the questions into sort of two parts. First, let's talk about the vision that you all have around technology and its future. And I'm going to be specific here. We're talking about asset owners who invest, obviously, gazillions. I'll give you the figures. Pension funds are roughly 45 trillion. And on top of that, you've got asset owners adding up to something north of 100 trillion. So these are the organizations that are very influential in every respect. And obviously the asset managers have mandates by and large, but I start out with the asset owners. Gordon and I do more work with the asset owners really than the asset managers. So from that point of view, I think the first part of the conversation is really about the technology visions you have for these organizations. By the way, technology hasn't been that big in that particular space so far. And secondly, I want to then be a bit more specific about this ESG moniker, which I think all of us will know as environmental, social, and governance influence on portfolios, but also how the sustainable investing proposition is being drawn up from ESG, which is kind of a bit like a building block. So I'm going to ask that question or discussion point in two parts. But first, that broader vision about technology. And Gordon, you were touching on where you see organizations like BlackRock in the future. Speak on about that.
Okay. Okay, so yesterday, two groups gave presentations in front of an Oxford committee. Both run 50 to 60 stocks in their active global portfolios, and they are all, each one of them is ESG sort of driven. And what was interesting about both groups who've come, they run about each about about 20 billion each, and they're boutique in some sense. You might think 20 billion sounds a lot, but actually in the investment management industry, not so much. And their stock portfolios were all technology-based. So they were looking to invest in those companies that will pay off in a 3 to 5 to 10 year period because they've got a lock on a technology that's going to make a fundamental difference in some corner of the productive world. And they basically, these companies want to ride that tiger through to the realization of value. They've picked out those technology stocks, that is companies that have a strong environmental flavor. One of the companies talked about Waste Management Inc. as actually a company, a North American company, beyond that, of course, that is in waste management. And of course, waste management is a terrible business to be in, actually, if you think about it. But the company has made huge strides in their knowledge base, both of their risk exposure to the risk management process, but also basically realizing the environmental management challenges that come with basically how we dispose everyday waste. Now, I think the kinds of technologies we've been talking about has massive applications to the global risk management industry, and actually the company, Waste Management Inc., is one of those companies with deep enough resources to actually adopt this technology and make a difference to their efficiency over the long term. So I think these guys who are doing this technology issue about sort of global satellite mapping feed into these other strategies right down at the stock-specific level, where they're really trying to bet on the technology that's going to make an appreciable difference. So that's my take on the technology issue.
And Martin, be specific, I think, about how asset managers use that technology for themselves. How is that evolving organizations like yours?
So my perspective is always like a real asset finance person, so therefore also like I'm not in the listed space so much. Of course, therefore I do have like a specific take on that. In our case, it's really like producing reliable real asset finance cases. So if you take the simple example of a wind farm, whatever, you really need to get a grip on like what the wind production will be, how the wind will flow, and there you need such sort of feed in, and you need to have richer data, you need to have better data, more reliable data, longer data, and then you can apply it. I guess like if you would ask someone from the more listed side how to take incorporate technology on their sort of analysis, that would be way more towards AI and towards more like finding the pattern, whereas in our case it's more about generating data, and as soon as you have that, it's rather than like the next step is more simple, I would say.
Yep. And Will, you're experienced across the spectrum of investment firms, so the interesting thing to me is about the expansion of methods that use machine learning, that use data science, that use AI in different ways. So how is that kind of momentum or train sort of moving at the moment, would you say, in an investment area, particularly that there are mainstream firms and then there are more specialized firms with respect to those disciplines?
Yeah, and my sense is that all of the sort of the large investment firms here in the UK have, or most of them have set up data science units and are sort of aware now of the potential value of those. So I was talking to one of those yesterday, and they gave me a couple of interesting examples of the way that they've used technology. And my apologies if you've read these case studies, but in the case of a merger of two gaming companies, they were able to quite quickly do an analysis of the location of all the various different shops that they had, locations that they had, and see where the competition issues were going to arise, and therefore sort of create for themselves a more informed view of how the competition authority decision was likely to play out, and where would stores have to go, and so on, which informed therefore their view on the relative prices of those two during the completion of the merger, and allowed some sort of arbitrage activity. You can also do work in the retail space, obviously, by aggregating census information with looking at the different types of locations of stores, then looking at the relative gravity of stores, So a very large store will draw people from much further away, but actually doesn't draw people who live very close to it because it's a pain to go to a very large store. And then you could work out which organizations that are running different strategic approaches have maybe got more opportunity for growth relative to others. So that demonstrates, I mean, technology actually is I think is not very expensive. I think that data can be relatively expensive to obtain, but it's integrating those two things in a useful fashion. So first of all, you have to think, well, actually this would be a good idea to do in the first place. Then you have to think, well, how am I going to set my technology up to do that? And instruct that technology to do the right thing with the right inputs. And then have some people that actually are trained and competent to be able to do those things. So it becomes quite an expensive process. But happily, I think that whereas a lot of regulatory activity is leading to sort of probably a smaller number of larger scale providers in the investment sector, I think that the relative low cost of technology and the opportunities that are available through simply, if you have a small number of people who are good at combining data and technology and the application of machine learning and artificial intelligence, you can build a competitive advantage and hopefully generate alpha relatively quickly and easily. And I think this will be beneficial for the health of the sector.
Okay, so let's talk a little bit about sustainable investing and ESG. So just a reminder that, in a sense, ESG comes in two levels. You've got an integrated version where people really are seeking a better return per unit risk. It's all about the value proposition just on those terms. But there's also this dimension of investing that some organizations are interested to pursue, which is about impact as well, and somehow that's balanced alongside the financial considerations. Just a reminder that the investment world has a great deal of difficulty with that second thing because it sort of challenges this principle of fiduciary duty, which is so much bound up with financial factors. Now, it's a truism to say that data is going through this massive transformation. So we all know that 90% of the world's data has come out in the last 2 years. And really, the essence of that is that ESG is one of the areas that is kind of swamped with data, interestingly. So really, I think the essence of what we have as a challenge is how organizations are going to basically use that data effectively. Gordon's talked about that. But also challenge, you could say, some of the soft aspects of data. So I think we've been talking quite a lot in the hard data area, but no doubt a lot of these things are about interpretation that have a softer element to them with provenance of data uppermost in that respect. So I'm going to sort of start off with you, Will, because again, you've got that great perspective across the industry. You know, how is that state of ESG, as you see it, developing?
Well, I mean, our sense is that most investment professionals would now reckon that integrating ESG considerations was actually just sort of part of the job. It's been pretty much mainstreamed. And that follows the much broader demands from clients, and you see that in the PRI signatories and the PRI AUM under management numbers, in that clients are just expected. And the good news is that they aren't expecting it because they want to be especially good global citizens, but actually they expect it because it makes good financial sense, because most of the academic research now demonstrates that integrating ESG considerations actually has a positive impact on net performance. And so I don't think there's sort of very much sort of question about are investment professionals interested and applying ESG information.
Can I just sort of stress or introduce the subject of the idea that the principles are accepted, but the practice is tremendously challenging. And so many people in the investment industry own up to the idea that the data is, I would say, the description is all over the place and the provenance of the data is difficult, and suddenly organizations are waking up to how difficult it is to use this data in the way that Gordon describes, which is in a predictive form.
I think it's difficult to use it well. And I think there are lots of people who are using it rather slightly. And there are happily some consultations that are going on at the moment to think about how we can label this area better so that we can distinguish more accurately between organizations that are doing the minimal amount required in order to badge themselves ESG and those people who have made a real commitment to it. But I think that those people who have made a real commitment to it, while they are obviously desperate for more and better data than they have at the moment, can do quite a lot to identify opportunities to, first of all, not do anything sort of additionally detrimental towards the Sustainable Development Goals, but also to identify where the greatest opportunities are to have a positive impact on those goals. And clearly, Earth observation will be a contributor to that.
And Martin, I know you deal in the impact area, but it would be interesting to learn how much your clients are interested in how you can present against those Sustainable Development Goals in particular.
Great question. Maybe just to comment on one aspect on impact you said earlier, like I do think currently we're in a position also due to the presence of data that we don't really need to sacrifice return for impact anymore. It's just the challenge right now is really like to quantify that and to find it and make that understandable also for the investors. And maybe on your earlier comment on the ESG integration, I would also take your position, saying like, and there again, like I speak about real asset investing, I speak about infrastructure. I'm chairing also an initiative at the PRI where we now publish the due diligence questionnaire also for investors in infrastructure on the question how investors have to integrate ESG. And for us, it's really like it's a diligent investor must have all those aspects under control. This is not something on like an add-on anymore. It's just really like a given. And if you can't really manage to understand those risks, you're just not capable of doing investment. So this is how we see that. On the impact side, what we currently see, first of all, to comment on the SDGs, I love them. They're amazing. Also, I think plenty of people really love them because of those great colors. This is really, they just look amazing. And they also give people a sense on what impact would mean. But in daily practice, they're not really meant to be steering your investment decision. They're very broad, and this is why they're so broad, where they can be applied to so many areas. But if you really want to base your decision on an SDG, like we're pretty early lost. And this is also nothing an investor would want. They want to understand, okay, if you want to contribute to that SDG, what is it really you mean? What's the KPI? How do you measure that? How do you report on that? How reliable is that? How ongoingly, how are you committed to that? And this is again like where digital imaging, like if we think about agricultural investments, stuff like that, this is really where you need reliable, long-tested data. And then also like if I could have like a wish list also for future reference of climate finance, if such satellite data would be doing the trick in order to backtest also investment assumption, I'm very certain this is also could in the long run in terms of lobbying allow towards like the regulators to showcase stability of investment decision, which would then maybe allow the regulator to ease the burden. Like if we think about solvency, the infrastructure quotas we see under Solvency II, aspects like that really ultimately would do the trick in channeling more capital into climate finance.
That's great. You snuck in the almost the single most significant vex question in finance, which do you have to sacrifice return for impact? And obviously that is a huge discussion point. And I always like the sort of the show of hands on this. So there is an answer that says, yes, I would have to sacrifice return for impact. And then there's an answer, no, I don't have to sacrifice return for impact. So who's in the yes camp here? Show of hands.
I think it's the wrong question. It's rather like sort of asking for a show of hands on climate change. Yeah, you can sacrifice return if you want to attain impact, but you don't have to. And this isn't sort of a matter of opinion anymore. Yeah, there is data out there that demonstrates this. So it's a choice. It depends on the intention of the organization that is making that investment. If they wish to make a grant they can make a grant if that's the most appropriate thing, or you can have blended finance, where part of that is grant-based and part of it is actually a commercial investment.
I like exactly what you say, Will. That is the more complicated end of the discussion. Trust me, when you go into an asset owner board, the discussion is already sort of split between those two versions. So it isn't. It is still to be discussed.
We need to re-educate.
Yeah.
Well, but
Gordon.
part of it is people come in and give a presentation on ESG, and you don't believe a word of it, and that's the truth of it all. And then some people come in with a fantastic, disciplined approach, and they're losing money, and you think, oh my God, what are we to do? I would say over 5 years, it's changed dramatically in terms of the presentation that you get from an asset manager. I have not heard an asset manager say, and this will cost you. Actually, they'll say, look at the benchmark, we will actually earn money over the long term. All things being equal. Of course, we know in finance, nothing is equal in the short term, and God knows where we are in the long term. But those are some of the issues. Let me just make one other observation, though, which is that the types of integration issue that we're talking about here, taking satellite data or other very rich data sources on a global basis, I think is expensive. And yet it's urgent. And I was not kidding when I said, if we're going to really make dividends out of this, it has to be on the Bloomberg terminal in 5 years' time. It has to be integrated into the process. What alarms me is when I hear asset managers talk about, look, in 10 years' time we'll be here, or a major corporation saying, look, in 2050 we'll be great. Actually, it's urgent. And we really have to be thinking about integration of these data systems into investment practice, and we have to think 3, 5, 7 years. Let's not think about in the long term we'll all be okay, because in the long term, as Kane said, we're all dead, literally.
So just to sort of close off the conversation and just have a little bit of time with questions of all of you, I would like to just touch on two things. One is a little bit about the skills needed to sort of make this big change in the way that we do things. I think it's a lot about how professionals in this room face up to that challenge. It's big. I think the other dimension here is being a little bit more specific about spatial finance data in the whole context of data. I think that would be helpful as well. So in no particular order, take either of those points, and Gordon first.
What's the question?
So the first part of it is, what do individuals need to do to develop the skills needed for this new world? And the second part of it is much more specific about how spatial finance is one of the most important dimensions of this data challenge going forward.
I think what's noticeable in some big asset managers and some big asset owners is the development of data science or data laboratories. And this is new in the last 5 years, that they've had to or thought to invest in the data management and building of data systems as a deliberate part of the management space. And as I said about some of the world's biggest corporations, they themselves have also come into this idea that we have to build our data capacity, because relying on third-party data just isn't credible anymore. So I do see in the industry investment in data science. The trick here is to integrate into investment practice rather than having it at a sort of those guys down the corner who you couldn't possibly talk to. So I think one of the issues that both Roger and I have often talked to asset owners about is this integration question, going from the data and its packaging and its design into investment practice in a way that actually is predictive and gives you sort of better results. I think that's where the challenge is in management. That's where the challenge is in converting data into a desirable outcome.
Great. Martin, do you want to add to that?
Here again, like the angle I'm taking due to the real asset nature of what we're buying, it's tricky because you as an investment manager, you really have to take the specific decision to buy into a project which you're then bound with due to the illiquid underlying nature for like the next 10 years. So therefore also you do need that sort of data. You need to have experts, and essentially then the job of a real asset investment manager is to run due diligence, to find the appropriate partners, to get the tune on the language that you understand each other, and then ultimately transform that also into your reporting requirements. Which again is why, like, universal data, single formats, help in understanding patterns is then ultimately long run the crucial point, which is where we see like easy to see pictures, but then really digging through that and transform that into understandable language for investors who then ultimately have to do the decision. That's essentially then the challenge for such individuals.
Right.
Just a very quick point. I mean, the people that are being recruited mostly into investment firms to do this have a background as data scientists that they've developed elsewhere. So we don't think that every investment professional is going to be a data scientist. But in the same way that we educate people to have an understanding of economics, we don't expect everybody who's an investment professional to be an economist, but we expect them to be able to incorporate and understand the generation and application of information around economics. We would expect investment professionals to understand a great deal more about the nature of data science, the things that can be done well or badly within data science, and how it can be used. And we would expect data scientists working in investment firms to understand more about the investment process.
Yeah, you've described it very well, and obviously at the moment we're early days in that transition by which those skills are fused, as it were. Is it fair to say, Will, that the investment industry has a bit of a difficulty, strangely, in attracting the most outstanding data science people, because they kind of want to go to work for organizations like Google or Planet, where really interesting kind of mind-bending things are happening, and finance doesn't have all the brand and the potential to be as significant?
Unfortunately, you've strayed right into my sort of favorite hobby horse, and so I'll keep it really short. But I think, we see, whereas 20 years ago, a lot of young people would have decided to take up a career in finance, they're now sort of much more interested in working in other areas, perhaps, and obviously technology is one of those. Part of the problem is that finance does not look like a very purposeful activity, and I think post-global financial crisis, we have a difficulty of positioning. But actually, this sort of application of data to problems that affect sort of real people and that you can talk about, and where you can apply capital to solving problems that are going to face all of us, like the Sustainable Development Goals, there is a real opportunity, and I know Sir Roger and others and Ben are thinking about this way too, to demonstrate the purposeful nature of finance. Finance plays a very important role, but most of the time it's rather boring. And when it's good, it's rather boring. But actually, we have an opportunity here to be engaged with something that is really rather exciting. And that is helping to solve the climate challenge, the immediate and appalling climate challenge that we have, but also the longer term sustainable issues that we need to address. So I think if we can make it evident that we are part of that process and use these kind of technologies and these kinds of skills to do that, we will probably bring more people back into working in finance than we might otherwise.
So just to emphasize that really we have had finance in its narrow form. I started out by saying that, but in a sense, so much more is spoken of about finance being an instrument of purpose. And that purpose, obviously, is really bringing better outcomes to more people. And that might just sound about like that's investors, but in a sense, surely finance should be bringing better outcomes to everyone, whether or not they have a stake in a fund or not. So in a sense, this is an exciting sort of transformation, I think, potentially in how finance does its future. So we have probably 10, 12 minutes to just kind of get comments coming in. I don't think we've got a mic, but if you could shout out comments. I'm going to take three questions at a time. So two down the right-hand side there to start it off. Maybe we have mics. Oh, we do have mics. Yeah, brilliant. Okay, so one here and one at the front.
Hi, Yako Kuroshi from FTSE Russell. Question for Gordon. We in December just launched our first index product that is driven by geolocation data, and it happens to be a sustainable investment product driven by geolocation data. It happened in real estate, and one of the reasons why it was happening in real estate is because listed real estate companies actually have to disclose their holdings, their real estate holdings and their buildings, and they don't move around, so they're quite easy to track through geolocation data. So my question is really, what has to happen on the corporate side in terms of disclosures in order for us to be able to link this data up in other sectors, whether it's, I don't know, the mining industry or retailers, or what kind of disclosures do we need from companies so that we can plug that together with geolocation data more effectively?
So are you asking what companies would report, I suppose, through some reporting agency or against some reporting requirements? Yes. The reason why I talked about some of the big companies we've been working with is that they've been less concerned with reporting to external groups, and more concerned about reporting internally to themselves, right up to the CEO in terms of their exposure, if you like, and risk profiles, as I said, at the very end of the empire, if you like, which is not seen.
Sure, but I mean...
If you're going to, or then ask them to disclose data, say, on supply chains and supply chain management and risk profiles that goes with that, that's a useful thing to do. It would take some time to basically put in place as public policy, but useful thing to do.
The question is, like, what type of data do you need from the geospatial side in order to really link this up? So obviously for the company CEO it's useful to know, but so does the finance community, investors want to know how to deal with this?
There's really three criteria. One's timely, really important timely in the sense of how a company manages itself and over what time horizon, really important. Fine-grained, getting down to the spatial unit that's actually, if you like, as someone said, relevant to, but also actionable in terms of the corporation's own decision-making. So timely, fine-grained, and integrity. What you guys can do, perhaps more than I think corporations can do themselves, is provide data with integrity that actually meets in terms of the truth statement that Will was talking about. That's really important. Because I think one of the problems in some major corporations is they don't trust their own reporting procedures to themselves.
Get Mike down to the front, and other ones here. Maybe there's one here straight away, so go ahead, please.
Hi, I'm an agriculture commodities trader and also an advisor to the Catapult. And with that second hat, probably a question that Gordon's discussion has kind of flirted with. Where do you see the opportunities for UK space technology and data science startups? And where do you see exactly the intersection between the pain points for the financial services sector and our local expertise?
Well, the reason why I talked about Fidelity and BlackRock is that they've got very deep pockets, and as a project they can invest in this actually without proof of concept. When you get down to the companies I was talking about, investment groups that are sort of running sort of 10 to 20 billion, really what you have to do, that's a relationship you have to form that basically is mutually advantageous, that takes your expertise and basically demonstrate value in the investment process both in terms of realizing value in the investment process, but realizing value to clients. And actually, there's quite a few in UK, Europe, of these relatively small investment groups who want to be data rich, but actually don't have the deep pockets of BlackRock and Fidelity. So it's a partnership that you have to form with them that actually is mutually advantageous and is a sort of a 2-year, 3-year type process that sort of reaps value. That's what I would say.
Good. Lovely.
Yes, my name's Sally Leavesley. I chair an international panel of scientists working on catastrophic risk. My question really is, do you think, and thinking about terminal asset value and strategic risk, do you think any of these products sort of could evolve for looking at cities as critical national infrastructure, as whole cities as critical national infrastructure, and looking at the survivability of cities? Because we're looking at nuclear threats, cyber threats, and natural hazards, and bringing this together across the data streams, it might make a difference to the world.
I think the answer is yes. We have been asked at the Smith School to do some research on vulnerability of major cities on estuaries close to coasts, because sea level rise is likely to be a question of inundation in terms of where people live and work. And in that sense, for government, it is extremely important. For the insurance industry, it's extremely important. Put another way, it doesn't take too many more times that Miami is flooded that Miami won't be habitable. So the question is both the storm frequency impact, but then actually what is the footprint of storms for Miami over the longer term?
I think we've got time for one more question. Okay, brilliant. Thank you.
Hi, Olga Cowings from the Economist Group. So my question is around relying on long-term data analysis. So if you're looking at climate change, you're looking at the impact over decades. And the presentation we had from Planet was incredible in terms of the resolution of the data that we get now, but going back 15 years, we had nowhere near the quality of data. So would you be hesitant as an investment or a risk professional to rely on data going back 15 years, given that it wasn't as high quality?
That, I guess it's to me. I guess yes. Essentially, it's really like if you also see like the pickup in like the dynamics, how much they change, and therefore, me personally, I would be, and it's ultimately really like you sitting there in the chair and like you really have to make a judgment. This is really super hard. Ultimately, you really have to develop your on-the-ground feeling often for a situation, but this is just like so multi-dimensional, so it's really ultimately close to impossible to really take a specific judgment on that. And this is why you go into data, and if you really see a jump in data quality, and then by nature you would mistrust like the older set of data. To analogize, take an analogy to that is like wind data. Like we see the same, like just like wind flowing as a proxy for your future revenue generation, and even that, which has been quite a long time, rather comparably easy to measure. Even that data proved to be like very hard to digest if you look into older sets of data. So therefore, me personally, I really would want to have like one consistent database, like to give you a principal idea, and then like as much data to enrich that. But I personally would like detach the both of the data series.
Just to amplify a couple of points here, which is interesting. I think our focus is quite, I'm going to say, short-term around some of this, how this data could be used at the moment. But really, the investment challenge is highly long-term. So obviously, the institutions that are out there have the responsibility to look after savings over 10, 20, 30, 40 years. And so from that point of view, the investment challenge is all about this VUCA world, volatile, uncertain, complex, ambiguous. And that's getting harder, really. So from that point of view, I think the investment industry has sort of sometimes caves in and says, okay, I can manage over 1 and 3 years, but I don't really have a position that's longer term. That's really where the asset owners on climate are starting to say more interesting things. And obviously how we interpret this data becomes so critical to the whole. So it's really so much more than data at the heart of it. It's obviously really about understanding the system And science is just going to play such a big part in that. Of course it is. So from that point of view, watch this space. I mean, I think that the key dimensions to sort of summarize on it is really that there seem to be a sort of stream of potentially insoluble problems, but really that's masking, I think, a torrent of opportunities. It's really exciting to see technology that was shared by Will, so I think that was really a high spot for me. And really the panel is really speaking to this new dimension of the investment industry, which is risk, return, and impact at the same time, which we in this room very clearly are optimistic about integrating successfully, because that's what the vote almost got to. So from that point of view, can I just ask for you to share with me in thanking the panel?